Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to be talking about whether or not you're planning with cash flow in mind.
And it's one of those things where everyone kind of thinks they are until we start having the conversation. Then they're like, oh, no, I'm not.
Yeah, I think really what it stems from is most people are focused on accumulation, meaning like how big can I get my number?
Yeah.
I think that's where most of their attention is. And they're not considering, look, when like throughout life, there's one factor that is always there that we truly care about, and that's cash flow, meaning the income coming in the door that's providing your lifestyle today and the income that's coming in the door in the future that's providing your lifestyle for the future.
Right.
And too much focus, I think, is only in one area, which is like, what's my net worth or what are my assets worth, rather than, okay, what do these assets kick off in terms of income? And specifically today, we're going to focus on like what's the taxes on that income distribution.
Yeah. I mean, it's hilarious to like have this conversation with folks. And like when we start talking about it, we're like, oh yeah, there's like 5 things we need to care about when we talk about retirement income. And they're like, okay, what all do we need to talk about? Because like, isn't just like bigger? And like once we start talking about the other stuff, people are like, oh, yeah, okay, that makes sense. All right, cool. How do we do like any of that? And
Yeah,
yeah,
it's pretty eye opening. I mean, it was eye opening at least for me when I learned it, and that's when I was already in the industry, right? Even I was focusing on either just like the protection side, and even then, I wasn't really fully protecting the true cash flow or income coming in the door. And then in the end, we're building these assets and financial planning with the thought of cash flow, right? It's
right.
always that. So, before we dive into all of this, though, Mr. Collins, what are you drinking today?
Today I am drinking Hazy in the Gorge from
I've never had that one.
Backwoods. It's yeah, there so Backwoods Brewing is out of Hillsboro, Oregon. This clocks in at 6%. It's got 65 IBUs in it. And it's just a delicious beer.
That's awesome.
It's really, it's smooth. You can kind of get the sense that it's a bit unfiltered. It's just this is a really good beer. So if you like hazy IPAs, highly recommend going and checking out Backwoods.
Yeah, definitely check them out. So let's dive into it today, Alex. So again, as we've already said in the intro, right? Like so much of people's focus, and it's a focus to have. We're not saying that it's not a
Right.
piece of the pie, but the focus is strictly how much in assets can I get? How do I grow my assets enough where I don't have to work if I don't want to?
Right.
And for you to not have to work if you don't want to, what do you need those assets to do for you?
Actually produce cash flow.
Correct. So if you have, and this is an overly simplistic example, which would you rather have? If you've got one person, let's just say we got twin A's, let's just say they've got an assets worth 10 million, and the 10 million kicks off 400K of income, right? And then after taxes, maybe it's like, I don't know, 300 of income net.
Sure.
And then you've got twin B who has 4 million of assets, but the 4 million of assets kick off. I'm sorry, 10 million was my first one. The second one, let's just say it's 8 million of assets, but the 8 million of assets is kicking off $500,000 of gross income, and you're netting 425, for example. Which would you rather have? Most people say I'd rather have the higher income. Now, some people might say I want some legacy, and there's other pieces there that we can get into in another episode. But today it's all about, well, I'd rather have the higher income because that means normally a better lifestyle.
Well, and like I guarantee you that like at least a third of the room is going, wait, you created more cash flow with less assets and you created more cash flow with less taxation.
Yep.
My head hurts. How did you do that other than magic?
Yeah, so go back and take a look at our tax distribution strategy episodes where we dive into the specific strategies on how to do so. Today is just more high level. So I'm glad Alex brought that up because you should go listen to that. Today is a reminder really of that episode of you're making decisions today of where to put money, either paying off debt or building assets or some combination of the two. Are you thinking with the end in mind? And in this case, are you thinking with the end in mind of like, how are you going to turn on the highest net cash flow to yourself in the future?
What? So I think you forgot a third option, which is consuming it.
Right. That's fair. Yeah. Which is, I embedded that in the lifestyle, but that's a fair point. So I'm going to share my screen here, Alex. So this is a fictitious client, although this is a client that we see all of the time. So it's based off of like data that we personally see every single day. And as you can see here, we're going to focus on two categories here, the asset category and how much they're saving and where they're saving. So this couple makes $500,000 a year in income, and they've got $100,000 in savings, $500,000 in investable assets, $700,000 of the 500 is in an HSA, health savings account, and they've got $940,000 in a traditional 401k, their work employer 401ks. Okay. And where they're saving money is in those assets. They're putting $6,000 a year, $7,000 a year into their HSA. They're saving $12,000 a year into their savings account, but that might go off to vacations, but it is what it is. We're putting $12,000 for today's conversation. They're saving $46,000 combined into the traditional 401k. And then the $30,000 investment account per year. This could be the RSU structure where they're getting $30,000 in RSUs roughly per year, or maybe they're contributing $30,000 a year into the investment accounts. So this is where they've decided to put money.
So how old is this couple, Ryan?
Yeah. So this couple is in their mid 40s.
Okay, cool.
So this is where they're deciding to put money. And this is where they've been putting money for the most part. As you can see, mid 40s, and they've got $940,000 in their traditional 401ks. That's a good chunk of change to be in your mid 40s and have that, right? So for most people, they're saying, yeah, they did a great job of saving. And I would agree. The question is when they thought about turning on an income stream, what's the tax distribution? Like how is income taxed? So imagine we had a pie chart, right? And that pie chart had three different categories. One category is fully taxable, right? Where every dollar that comes out is taxable at ordinary income rates. And that color would be red. One category would be partially taxable, or the possibility of partially.
Yeah, potentially partially taxable. The method of distribution and how people go about it, what we're after there is, can we get some of that money back without paying taxes on it?
Correct. And then and that would be in yellow. That would be the yellow category on the pie chart. And then there's the possibility of non-taxable, right? Where if you're distributing the money, it could be non-taxable. That color would be green. So if we had this pie chart, and if you're thinking about your own personal balance sheet, again, reminder of the colors, red is fully taxable, yellow is partially taxable, and green is non-taxable. Which color would you most likely want, like the majority of the pie chart, what color would you want it to be?
But this is not going to come as a shock to anybody. The colors are indicative of what color you'd want.
Green, obviously, right? And so the good news is we have a way of looking at that. And as you're seeing, by the way, if you're driving and you can't see this, definitely check out our YouTube channel because we're showing the screens. And I think that does have an effect at least for me, it helps with really kind of gathering the knowledge and making it sink in and seeing the visual side of stuff. As you can see with this pie chart, the majority color is red. Now they've got a good chunk in yellow, which is good. And they've got very small amount in green. So if they're still, now this is what they currently look like. If they turned on an income stream today, this is how their assets would be taxed. So now we'll go back to think about where they've been putting money. They were putting $46,000 in the traditional 401ks. That's making this red pie chart bigger, and even bigger based on rate of return and compounding, right? They're trying to make their number as big as possible. So if this is compounding, it could get larger and larger.
Plus employer contribution through matching or profit sharing or any other like aspect. Yeah. And when we start to try and talk about like, okay, what are the different ways that we can affect this? There's really two ways that we can affect it, right? The first is where we're putting dollars, and that would be a cash flow allocation decision. And the second way would be actually like changing around the actual assets. Changing around the actual assets might be painful. Like there might be some taxes, there might be some fees, there might be some penalties. It's not saying that we can't do it. The question becomes whether we want to do that or not, which is an entirely different conversation, has a lot to do with individual situations and circumstances. We do not recommend just trying to make everything green for the sake of making everything green.
Yeah, this goes back to, and you and I have said this maybe on every single episode, right? We don't know what taxes are going to look like next year, let alone 30 years from now, 40 years from now. But if you have different assets and different classes in terms of how they're taxed, now you have flexibility and you can have different levers to pull from each asset, like pull some from the green asset this year because tax rates rose, or whatever. You've got the flexibility built inside of that. But most people, like, this is why I don't know about you, Alex, I'm reading a ton of articles around like Roth conversions, right? Meaning a lot of people that are retiring right now, they're thinking about, oh, I should convert my traditional 401k money to Roth, meaning tax-free money, but they're having to pay the taxes on that conversion this year.
Might it have been better for them to have put it into Roth in the first place 15, 20 years ago?
Correct. So again, this isn't a all green conversation or nothing. This is a conversation of understanding how you currently look today, with the purposes of, look, like you're saving your money for really like 2 or 3 different reasons, right? Cash flow tomorrow, legacy, and security.
And tomorrow is just some point in the future, not literally tomorrow.
And when you think about that, do you want all of your money in cash flow being taxed at ordinary income rates? I've never heard anyone say yes to that question. Do you want your money being passed down? Do you want your kids to have to pay the taxes on that money when they inherit it?
No.
Again,
Yeah,
never heard anyone said yes to that question.
Right.
And when it comes to security, wouldn't you rather have access to the money where there isn't high tax penalties in the event that you actually needed it? Again, no one's ever said, I want that to be fully taxed. Right? So this is why we need to think with the end in mind. When we are saying think with the end in mind, you have to think from the standpoint of turning on an income stream from your assets.
Well, and this is why it's important to look at things like comparative analysis and be willing and able to look at like, okay, not just what does this do for me this year, but what does this do for me, down the road, and like, what is a reasonable assumption, and like how would we choose to do it? And like one of the things that you and I talk about fairly consistently with folks is, hey, we are an advocate for the older version of you. Like imagine if, like, I think it's all fairly easy for those of us that are in our 30s or 40s or 50s to imagine having a conversation with ourselves when we graduated high school, when we graduated college, and saying, hey, you need to know this. If you learn nothing else, here is the like 1 or 2 things that will change your life that I know now that I wish I knew then. So that's the exact same thing, only you and I are trying to have this with clients, and we're advocating for their 60-year-old self, their 65-year-old self, their 70-year-old self, saying, hey, we need to think about these things, and let's look at what we would want when we're 65 or when we retire or when we're 70 or 62 or whatever that age is. Like, let's look at it and think about it.
Now, this is a piece that when we show clients, it's a big aha moment, especially for those of them that maybe have an advisor currently. A lot of times we're hearing, my advisor never spoke about that. They spoke about growing my wealth, but they didn't speak into this piece and, many other pieces that you and I speak into, right? So we look at the entire picture, and thinking within mind, which I think that's what we all want to be doing to begin with. So with that being said, Alex, what's our question of the day?
Our question today is not just what do you look like today, but what do you want to look like tomorrow / at retirement?
So head over to beerandmoney.net, and at the top of the page, there's a contact us button. That's a great spot for you to reach out to either answer this question, or if you would like an analysis of your current balance sheet to what we're showing right now, contact us through that and we can set up a meeting with you to go over that. Like, the whole reason we started this podcast is to help you think differently about your money. And it can be hard to go through this type of analysis. We're here for that, or at least go through your own analysis and look at it from that standpoint as well.
Well, and if this sparked questions that are, yeah, but what about?
Yeah.
Like, reach out to us and we'll help answer those questions and talk through it with you.
Absolutely. Look, we started this podcast again to help you think differently about your money. Specifically, we work with a lot of families, and our goal is really to help you, show you what's possible with your money so you can spend time and be with your family. So we hope this episode was valuable for you. And as always, Mr. Collins,
cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
Pinpoint number 7007401-1, expiration September 2026.